The Feds just cut rate for the third time this year. And of course, the news headlines make it seem as though we are slowly inching our way back to 2020 rates. That's not going to happen.
Forget about
Today,
it.
I'm going to break down what these rate cuts really mean for your savings, your credit cards, your loans, your investments, because the stuff you think will change is not. But the stuff no one is talking about, that's what hits your wallet. But first, my name is Loveth. This is Money Conversations, where we understand that wealth is not a flex. It's not about how much you make. Management is. If you enjoy any part of this video or learn anything, then do us a favor and hit the thumbs up because we're still trying to grow this channel. All right, let's get right into it. This recent rate cut wasn't just a rate cut, it was really the Feds coming through to say, don't expect cheaper money anytime soon. We were all expecting two more cuts, but the Fed has said it's going to be just one, and we may get another one late 2026. They're in no hurry. So here's the big picture. Rates are coming down slowly, emphasis on slowly. That era of cheap money is not coming back anytime soon. And your wallet is not going to feel relief where you expect it or where we thought we would get it. Let's start with the part no one wants to hear about, our bank accounts. We were barely getting pennies, and now it's about to get even lower. The national average for checking account was 0.07%. I mean, that's pretty much nothing. For savings account, it was 0.4%, barely anything. The only thing that kept us afloat, at least beat inflation, was the high yield savings account. Well, with rate cuts and future rate cuts coming through, those rates are about to get lower. So if you're not using high yield savings account right now, or if you're not shopping around for better rates, you're actually just losing money because we only have a short window for the rates we're currently getting. Now let's talk about the part that frustrates everyone: credit cards, credit card interest rates. The Feds have been cutting rates, prime rates have been coming down. But credit card APRs, no, that stays where it is. They always find a reason to stay high. They never come down. We are currently sitting at 21%. Your credit card, I know a lot of you probably haven't looked at how much you're paying in interest because it's painful to acknowledge. It's the highest it's been in years. Credit card companies don't follow the Feds. They raise rates super fast and they stay high. Even after 3 rate cuts this year, credit card rates have remained where they are, the highest in years. So in 2026, if you're still borrowing money from credit card and not paying off your full balance every single month, it's a financial quicksand. There are no two ways about it. Now, for those of us waiting on mortgage rates to decrease, to get back down to just what it was a couple years ago, 3%, we need to wake up to reality. Unless something major happens, something catastrophic happens, it doesn't look like it's happening anytime soon. Yes, the rates are a lot lower than they were at the beginning of the year. They are 0.5% lower than it was last year, but it doesn't look like we're going to see that 3% anytime soon. Remember, mortgage rates do not follow Fed rate. I explained it in this video. They follow the 10-year Treasury rate. And right now, that 10-year Treasury rate is still above 4%. So that dream of 3%, at this point, I would take 4.5, 5%. I'll take it. Every forecast so far, Mortgage Bankers Association, Fannie Mae, they all say the same thing. We should expect 6% mortgage rate through 2026. So yeah, rate cut is good and it helps, but it's not really making the massive difference that we need right now to alleviate all this high cost of living we have. But here's one area we could see real relief: personal loans. Personal loan rates were stuck at 12% over the last 2 years, and they're finally sliding down to 11%. To be competitive, some lenders are marketing 8%. So if the Feds keep cutting rates, you could see even lower rates. So if you're interested or have been thinking about consolidating your high interest rate debts, you could have a good 2026. You have a good window opening up here for you, and that will make a big difference. Let's talk about investment, the effect of these rate cuts on your investments. Most people think rate cuts lead to stock market boom and rally, and sometimes it does, sometimes it doesn't. If there's anything we've learned this year, is that the stock market is really independent and is very sensitive because it doesn't move on only corporate earnings and economic growth. It also moves on investors' confidence. So the stock market, the economy could be doing great, but if we think it's about to go downhill, a lot of us keep our money away. And some of us invest knowing we're buying on a sale. Some of us chicken out and we're afraid to lose money. right? The stock market, in a sense, is independent, regardless of what the Fed does. It's not just based on the numbers of the economy and the growth and the corporate. It's also based on how we feel, our perception of both the corporate world and also the economy. So if you want to win long term, here are two things you must do. You have to ensure your portfolio has quality stocks. You're not just buying stocks because any Dick and Harry on YouTube tells you they're about to have their payday and they're about to blow and it's about to be the next one. I mean, and with YouTube algorithm, you watch one and they all start coming from the woodworks. You need to make sure when you buy into a company, it's because you understand what they do, you understand their numbers at least as much as you can. You understand what the potential is. You also want to make sure you diversify and not just buying the sector that is currently booming. AI and the tech world has really made a lot of people rich this year, but that does not mean it's going to continue. You don't want to make a majority of your portfolio AI and tech because of the success it's had over the last 6, 8 months. But then again, I'm also one of those Dick and Harrys on YouTube. So this is not an investment advice. This is a general advice. Do you and do what suits you. So yeah, the Fed's cut rate. But the big news is it doesn't fix everything. It barely fixes anything. The real move is understanding where you're getting relief and where you're still getting squeezed, which right now is still everywhere. So at the end of the day, it's about managing your wallet, understanding that they're still not looking good, unfortunately. So don't let up on being conservative with your spending, with managing your money, and holding on to a lot more of your money because 2026, unfortunately, unless God steps in and miracles happen, 2026 does not look any better economically. I hate to say it because I don't want to profess negative. It will be better, but we've got to be smart, right? It will be better. We'll profess positive. It will be better, but we have to be smart with how we manage our money because once again, management, that is the flex. If this video has helped you any, if you have learned anything, or if you have woken up to anything, don't forget to give us the thumbs up. And if this is your kind of vibe, if you're enjoying this type of videos, then go ahead and subscribe as well, and I'll keep it coming. Thank you all so much for watching. I will see you in the next one.